Thanks for listening to The Derivative. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.
Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world.
On top of what our managers do. So we think we add value by allocating and weighting different sub-strategies in our portfolios. We think we can add value through reducing risk in the portfolio, increasing risk, and that's only possible if you can really rely on what the managers will do. You know, you have some expectations regarding their positioning or their performance going forward, given a certain scenario.
All right, welcome to The Derivative. I'm your host, Jeff Malik, and zooming all the way to Sweden today to flip the script a little bit and talking with a professional allocator to emerging hedge fund strategies versus our typical guest who is one of those managers. So who are hedge fund managers trying to convince that they know their stuff and are worthy of an allocation? People like Alexander Mende, who is with us today. Welcome, Alex.
Hello, Jeff. Nice to talk to you again. Last time in November, I think.
I think so. You visited Chicago.
Yes.
So Alex is a senior investment analyst and head of investment research at RPM Risk and Portfolio Management, which means he's vetting and selecting strategies for proposal to the firm's investment committee. So we're going to be getting into manager selection, due diligence, red flags, and who Alex's favorite ABBA member is, hopefully. So thanks for staying up late and joining us from Sweden, Alex. What time is it over there?
It's 5 p.m.
5 p.m.
So
and
it's not that late, but it's after this I'm going to go home. So.
Right. And where you're in Stockholm?
We are in the center of Stockholm. And takes 25 minutes with a bicycle to go home. So
nice. What latitude is Stockholm? It's going to start to stay late till 10 p.m. or something? Yeah,
no, it's in about 1 month we don't have the sun doesn't really go down anymore, so it's pretty light outside these days. The sun goes up at 3 a.m. in the morning these days. So
really? Nice.
You better be turned to the correct side of the bed so you don't wake up from the sunlight coming through.
And so Sweden's been in the news for kind of not doing the total lockdown. And so you've been going into the office this whole time and whatnot?
In Sweden, lots of things work through people doing it voluntarily, right? So we are working the office here in shifts. So at the operations team, there's always half of the staff that's working is staying at home until noon, and then they switch with each other. We are not taking the public transport anymore. We're going by bike or walking or by car. As soon as we feel sick or a little bit, but we stay at home. We work from home.
Which
side of it? Pardon me. Yes.
Which side are you on? Do you wish they had done a full lockdown, or you think it was a good move to do it as they did it?
Well, the whole point with this, getting people on your side and doing it voluntarily, is that you can do this for many months to come. And if I look, I'm originally from Germany, and I have friends there that have been in lockdown for 6 or 8 weeks now. Even, if the second wave comes, it's going to be hard to tell people to lock them down again. So they're really
for sure
frustrated with that. And
and we saw here in the U.S. over the holiday weekend here, there was the Missouri Lake of the Ozarks, just pictures of partiers shoulder to shoulder in pools. And so once they lifted the lockdown, one ounce, people flooded in there.
We actually, you see groups in the park, but you have volunteers going between those groups with a measuring instrument to tell them, okay, you guys move further away from each other, and then people normally do that. So it's all pretty peaceful and nice, I would say, so far at least.
Got it. And then we were talking offline. You're going on vacation right after this?
No. There was misunderstandanding with. It was the vacation was last week.
Last week, where'd you go?
Not far, Stokholm area, just outside.
You guys have a bunch of lakes in the area, right?
We have, I think, the largest archipelago in the world.
Really?
Yes.
I like it. And so you're also a lead singer and a saxophonist in a band?
I'm also, that's what I do in my spare time. I'm a singer in a punk rock band.
What kind of music you guys play?
Yeah, punk rock and ska, and alternative music, so to speak.
In English, you sing?
English, Spanish, and German, actually.
Really? All right, that's impressive.
But that's actually that's off the table these days. I don't think we're going to play a show this year anymore. So.
Oh, there's no virtual shows?
Nah, you can't do that really. I think because there's some latency in the transmission. So.
Yeah. And so what else we can talk about Sweden? You've got your all the Americans know is IKEA and Lego,
yes,
right?
Lego's from Denmark, actually. So
close.
Close. Oh, but you know how neighboring nations are. There's always some competition between the two. So Lego is from Denmark and IKEA is from Sweden and Aber is from Sweden as well.
All right. So forget Lego. IKEA's got to be hurting during this. I don't know what their stores are doing, but I think they're not.
I don't know. I haven't bought anything there for years, so I'm all set up at home. So I don't know.
Awesome. So let's get into your background a little bit. So what was your education and whatnot, and how'd you end up in this business?
All right. I'm originally from Hanover, Germany, and that's where I did my PhD in economics at the Leibniz University there in 2005. Then I moved to Sweden because I had a Swedish girlfriend at the time, and I found a job here at RPM and have been with them ever since. So that's not so long, my background. Did
the girlfriend become the wife, or that you're
No.
But you're still in Sweden.
I'm still in Sweden. I like it here. I like the culture. I like it's very clean here, I think, compared to continental Europe. It's people are more, I don't know, more straightforward. So no nonsense. So I like that, and it's not so warm.
I'd like to visit someday. I've never been to any of the Nordic countries, so that's on my bucket list for sure.
Yes, I think you should do that.
So, and then RPM found you. So give us the elevator pitch on what RPM does and what your role is within the firm.
All right. So RPM, Risk Portfolio Management, was founded in 1993. So long before I joined. It was originally management buyout from a similar company owned by the Wallenbergs and Johnson families. But since then we've been independent, and we're basically doing the same stuff since day one. We are a fund of fund specializing in different products and services in the CTA space. So we do everything right now from risk management services for managers themselves. So we have actually some managers where we do the independent risk reporting for. We have platform business. We were pretty big in the structured product business with Japan like 15 years ago. But we also do, we have the 2 actively managed funds with our name on it, where we actually have full discretion about choosing manager, allocating between managers, changing the overall trading level of the portfolio, the leverage, and so forth. Yes.
And the DNA from the beginning has been kind of CTA, trend following.
Yes, and that there basically was all trend following in the beginning, and that has expanded that universe as we do something that we call strategy balancing. We think there is more than trend following in the managed futures space. So currently we have 3 diversifying strategies. One is what we call short-term trading, so that's technical non-trend. We have systematic fundamental, so global macro kind of strategies, and we have also since 2017 VIX volatility traders. And right now we are looking into commodity only technical strategies, so no discretionary strategies at all.
And so no discretionary across the whole book, so everyone's got to be systematic.
Everybody has to be systematic. I have to admit, we've tried discretionary managers, but it's really, it's not easy to repeat everything over and over again for a discretionary program. And what we think our edge as RPM is to be able to add value on top of what our managers do. So we think we add value by allocating and weighting different sub-strategies in our portfolios. We think we can add value through reducing risk in the portfolio, increasing risk, and that's only possible if you can really rely on what the managers will do. You have some expectations regarding their positioning or their performance going forward, given a certain scenario.
Yeah, and I agree. The problem for me with discretionary managers is when they're in a drawdown, right? There's nothing to tie your hopes to, or to say, okay, right? He may be going through a divorce or having some other issues, and you don't know whether he's in a bad mental space or whether his strategy, quote unquote, is struggling. So I agree, that's difficult. And so how many millions or billions of dollars in AUM agree that you guys do this well and have an edge?
You mean how much money we manage?
Yeah.
Okay, so in the RPM Evolving CTA fund right now, there are 100 million only, and that's invested across 11 different managers. And there the smallest allocation is 3 million, and the largest, I think, is 12 at the moment, depending on the underlying volatility.
And then, but the overall firm is how big?
The overall, that's, as I said before, like platform business with management, that's more like advisory capital, that's more in the area of $1 billion. But, and I must say that this RPM Evolving CTA fund has the edge is to invest in managers in their evolving phase, which we come up with the term to like small and young managers. So not emerging managers. We don't provide seed capital. We don't want an equity state or anything like that. And we don't want to analyze any simulated or backtested data. So they have to have 1 or 2 or 3 years of real track record. There has to be some money in that. That's not only prop money. So we want to be early stage investors. And that's of course for our investors, which are mainly pension funds and family offices from Europe. Yeah. For them, that is in addition to their existing CTA exposure. So most of the family offices or corporate pension funds, they already have some CTA exposure to. The typical names would be TransTrend, Aspect here in Europe. And we are, in addition, we are diversifying that bucket.
So let's dive into that a little more. So and you guys have done the research and found that there's a alpha there to these evolving managers that they tend
we started that research in 2010, and the actual fund was launched in June 2013. And we find that smaller and younger managers, there is a small cap risk premium, so to speak. There is some kind of outperformance for smaller managers, even if you subtract all the reporting biases in the databases like backfill bias, survivorship bias, and so forth. So there is still a significant 1.2% annualized outperformance for smaller managers over larger managers. We find that all the large players today generated their outperformance and subsequently their asset inflows in their early years. So there's also like some kind of young premium, so to speak. Yeah. So we don't believe that every single manager that we pick will be the next Winton or next Bridgewater, the next Star or something. But we hope that the 1 or 2 of the managers that we've chosen over the years have shown that they have actually grown to large shops, like for example John Street or ADG.
Yeah. And so, do you feel? What do you attribute that premium to? Sometimes it's just, in my experience, sometimes it's just that they are taking on more risk. So is it higher absolute return or higher risk-adjusted return as well?
We're talking higher risk-adjusted return. Of course, there are managers that have quite high volatility in there, but we combine them in a way that it evens out over the different strategies. So the target risk in RPM evolving is 15%, and we're quite close to that, have been since inception. What I think is most of the managers that we meet and that are starting young have been working somewhere else. So they come from a big shop like Aspect, for example. Or Winton or Campbell in the US, and they think they want to try something new, but they have maybe want to have developed the system further, but have not come through their investment committee to start this. At larger institutionalized managers, things take longer time. That's natural for larger corporations than for 2-3 people sitting in one room.
And so a lot of times larger investors I speak with, they say, yes, I get it that there's that premium to the evolving managers, but the dispersion in the returns is so high, basically, that it's not worth it for me to try and capture that premium, because if I'm wrong in my selection, I'm really wrong.
That's exactly where we come in, because we take this risk, and we think we have such a long history and corporate experience with picking managers that we can mitigate this risk. And that's also the reason why we not invest in emerging managers, but evolving. So they have been around. There is actually some data to analyze. There is an audited track record. We have around north of 150 manager contacts per year. Maybe not this year with Corona, but who knows, but normally. So we meet quite a lot of different managers, and we think we are quite good at picking at least the managers that don't fail. That's the most important thing, right?
Yeah. And so evolving, so what, is there a minimum asset number they have to have, or just this time and actual track record?
We have we have flexible age and size criteria for different managers belonging to different sub-strategies. So simply speaking, a trend following manager can be much larger than a short-term technical kind of strategy.
Yeah.
That we would still consider them young and small.
So it's kind of, they have the same percent of capacities sort of concept, that a trend could be 100 million and still is very small percent of,
or even 500 million actually these days. But short-term trader above 300 million, then it's not so small anymore compared to the other small-term traders in the business.
And so on, and then the size component is, do you believe when the managers get larger, right, there's two different concepts there. One, they just want to sit on the money and not take as much risks and just get paid a annuity, so to speak. I don't know if that really goes on. That's sort of a perception out there.
It's difficult for systematic managers, right? They have a system, so.
Yeah. And then, but two would be they've just become better, right? You've learned to identify risks and eliminate those risks. So you just become better, and you kind of take the risk out, which also brings the return down, but the risk adjusted return remains high or goes higher.
Well, it's a philosophical question. Our research shows that it actually goes hand in hand, that it's not really, it's a circle of life, circle of strategies, circle of trading ideas. So I think it's important that there are new ideas and people try new ideas, and the new ideas are, if not better going forward, they are at least more diversified within one portfolio. So you can, if you pick, let's say, 10 small managers, they are doing much different things compared to each other than if you pick 10 large names.
Right, and almost by definition, they need to do something different to be a valuable entity, right? If they're just doing the same thing, they'll never get ahead of the guys in front of them.
And I must say, from this, managers that we are interested in, there's always some edge to it or something. Their story, they tell me, even the trend following managers we have, they do something different from all the other trend following managers we've talked to throughout the years. And the latest addition to our trend following book, for example, does something that I have never heard before. But I think as soon as I heard it from that manager, I was like, yes, makes sense. Why doesn't everybody do it like that? So
right.
It's very exciting, actually, for me as an allocator to meet those new guys.
Right. Can you tell us without giving away the secret sauce, what that is?
Well, it's a trend following system. So the first trade is always the strongest trend following signal. But the second trade they put on is not the second strongest trend signal. The second trade they put on is the one that's most diversifying to the first trade, and so forth and so forth. So they build in a hedge and allow themselves to have more flexible, more larger stop losses, so they don't get stop out so often.
Yeah,
because they count on this diversification, which of course not always works, but it's very different from what I've heard from other managers.
Right, what you see in a classic trend follower, right? They go long 30-year bonds on Tuesday, long 10-year notes on Wednesday, long 5 years on Thursday, long the bobble on Friday. So those trades, yes, tend to cluster as the whole sector. So they would not put on that. They'd wait for something in another sector. I like that.
Yes.
And so this gets me thinking. So if the premium is when they're younger and smaller, if they get bigger or older, do you take them out of the portfolio?
Well, there's no hard, we don't, happy birthday to your 5-year track record, goodbye. No, that's not how we do it. But I would say if a manager has especially reached a certain size, so size is more important than age, I would say, has reached a certain size, we start looking for a replacement.
Okay.
And yes?
I just want to circle back on that size component. So why do you think size hurts a manager?
Well, from the larger managers I've met so far, is that a large chunk of the research capacity goes into trade execution, how to best do your trades without leaving a trace in the market.
Yeah.
And there's lots of studies these days that actually the large allocators, including trend following, not only CTAs, but large allocators, they actually drive the price around different roll periods. And there are smaller managers that basically try to front run these trades as a trading idea.
Yeah, so it's zero-sum concept of it's a zero-sum game. If you're the biggest person pushing it around, it hurts your... And then there's also position limit issues too, right? Of they can only have so much size in certain markets.
Yeah, what we see about our smaller managers is that they are, on average at least, faster, at 5 to 10 trading days faster turning around the position. If you stick now with the trend following guys. And they have a larger commodity exposure often as well.
Which is sort of, again, by they can have it, right? Because there's
yes, of course.
When you're multi-billions, you have to be in financial asset.
Yes.
And then, are they mostly trading U.S. markets?
No, not yes, but European. We have a manager that is very focused on Europe, and we have another manager that's very focused on Asia. So I would say it's pretty mixed. I have no idea what a normal distribution would look like regarding market exposure or exchange exposure in that case, but I would say it's pretty evenly distributed.
And so that's the evolving fund. And then is there another fund, the Galaxy fund?
There's another fund, Galaxy. That's basically offering several large names put together for the price of one. That's how we market it. Yeah. But that portfolio has actually not grown in recent years. There is an interest. People buy the idea that smaller managers might have an outperformance component in there. That smaller managers are more diversified with each other, and therefore we have seen inflows in the RPM evolving, but not in large managers' portfolio.
Got it. And those are some of the big. That's mostly trend following, the Galaxy.
That's mostly trend following, yes.
And what are your thoughts overall on trend following? Like it's just come through this recent crash, not looking so great.
Well, the recent crash. Okay. Let's talk general first, and then about the recent crash. Generally speaking, trend following managers profit from something that's called time series momentum. And this Moskowitz paper from 2012, we call it trendiness, or had been called it trendiness since '95, and you can show, if you measure this trendiness or this time series momentum, that the intervals of market trends have become, there's more non-trend environment. The environment has become more non-trendy, and once the trend gets underway, it's always cut short, at least since 2011. And that's basically central banks intervening, providing more liquidity, or promising to buy corporate bonds or anything like that cuts the trends that we profit from, mostly on the bearish side, that cuts those trends short.
Right. So that kind of begs the question, is that the new normal and you should not be looking at trend, or this is just, it's affecting it until that all blows up and then trend is going to be the star for the next decade?
Well, last year, trend following was our best strategy. So last year was, despite all the choppiness in the equity markets, there was some trends to catch and follow.
Yeah. And bonds,
2014, second half, also a good example. I actually think that trend following managers, even the large one and the small ones, have become better in exploiting that little time series momentum that there is. So that's one thing. And, we at RPM are convinced that this cannot last forever. That's basically, how. So we are true believers and hope that will return.
But what do you see from investors? Do you get more calls of like, oh, I'm not interested in trend following these days than 5 years ago, than 10 years ago?
No, I would say it's a constant interest. The interest is constant, but the actual, let's pull the trigger, let's invest in RPM or in trend following in general it's a harder threshold. As long as the equity markets are climbing to new highs every year and there's nowhere else to, you need to be. So it's even now in this crisis, how much is S&P is down 7 or on the year or something? That's not really, in my view, reflecting what's going on.
Yeah, and I think NASDAQ's back at all-time highs, I believe.
Yeah. So if you want to talk about the Corona crisis, or as someone called it, the Great Corona Crisis, GCC.
I know it needs a name. I've been trying to get a name going, but nobody.
I heard GCC. So
GCC.
Yes. So that actually lasted only 15 or 20 trading days, depending on how you view the first week of March before Trump's famous speech. The first week of March, equities were actually going up again. So that was kind of a rebound there. So, and if your typical trend following system has a trading horizon of 30 to 60 days, that's the medium-term trend following system, the standard one. Yeah. Then you cannot catch a 20 days move. So actually the large.
Even worse, you get short, right? If you get short at the end of that 30-day move, and then it rallies back.
Yes, that's actually what happened in our portfolio as well. It wasn't so bad that we were down in March, but that's happened. The last week was actually, we got hurt more by the rebound than the actual, sell-off in the first 3 weeks.
Which seems to have been the case. I tell my son is 11. I tell him we've been in trend following's been in drawdown your whole life. Which it seems like it's been since 2008 that it's been basically one big drawdown, little tiny maybe peaks to new highs, but essentially, and it's just because of that, of many false breakouts and whipsaws. So the question just comes back to, is that the new norm? And they need to move to shorter time frames, and they need to be able to either identify those whipsaws or step aside.
From what we do in our portfolio is, exactly. As soon as you divest, then it's going to be the greatest year for trend following ever, right? So but what we do in our portfolio, what we've seen that works, is that we have allocated away from the medium-term space. So we have but we have our portfolio weights are more on the long term and on the much shorter term than 30 days. So we have short-term traders and short-term trend following managers in between daily trading to up to 15 days. And then we have two really long-term managers that have a longer-term trading horizon than those 30 to 60 days. So, and that combination has worked quite well so far.
Yeah, in a perfect world, you would have across basically every conceivable time frame, and getting in on the way on the trend, getting in as the trend evolves, and then slowly getting out as it dissolves. So, Alex, you also mentioned something about adding volatility traders and some different types, not just trend following, to the evolving series. So tell me what other strategy types you're looking at there.
Well, we always, we're trying to optimize the overall portfolio by adding different kinds of diversifying strategies to the main trend following block. And that started in 20 years ago with systematic global macro managers. We added short-term traders by 2007, 2008. In 2017, we've added VIX volatility trading strategies. We had been looking at this strategy block since 2012, I think, actually, but the manager we had put our eyes on didn't accept the way we want to do business. We can only invest through separately managed accounts. So if you're a manager, you're not willing to do that for us. So, but then by 2017, we opened two accounts with two volatility managers, both US based. And very different from each other, and as the research has shown, that's why we picked those two managers. The combination of the two is exactly the managers that we wanted to have in the first place. So that's
perfect. And what are some of the difficulties you see in analyzing those? Because just the VIX futures came out later, so the track records are shorter.
Well, VIX is a totally different animal from all the other financial time series. It's not trending so much, or not, at least not on longer time periods. And the underlying pricing is different. So, but greatest problem for us is that we are no volatility experts. Definitely not. So, I know what it tries to measure, and I know that people, buy VIX futures because they think it's protection against any crisis, but it's actually only against equity crisis. So, exactly. So, but the managers that we have were quite convincing in explaining what they do and why they do it, what they do, and
but is that still a trend following type profile? So like a positive skew?
No, it's not. It's not. One manager is a like relative value play on the VIX curve, and the other is volatility neutral, but taking a long or short position in volatility every day. So basically has a fundamental input or flow input, and then decides to be long or short volatility.
They could be short volatility. They could be capturing some of the decay.
Yes.
Yeah, which was great match with a trend following portfolio, because that's typically when they're getting hurt, right?
Yes. But trend followers get also hurt when the VIX spikes on these typical VIX days. Like 2018 was just VIX-mageddon, VIX-plosion, VIXmas, or what you have, February, October, December. So we're actually adding right now a tail risk volatility strategy. So a manager that's actually protecting our portfolio when volatility spikes.
Perfect. Yeah.
Hopefully that works.
And to me, investors like some of those better because it's less path dependent, right? So it's just, hey, if this happens structurally, this VIX is going to go to X and you're going to get a payout, versus classic trend following where it's, hey, we're going to need, if we're not already long equities and if we're not short bonds and if, there's 10 ifs, that if those all line up, then we'll make money on this down move in stocks. So
yes, but all those ifs are also quite new, also since quantitative easing and since the last crisis. So
but it seemed like, who knows if we'll ever be out of quantitative easing now, right? We just added another 3-4 trillion globally, but maybe they're finally getting close to out of bullets. You think so?
I'm not an expert in anything, so I can just
accept the
at some point it's something that goes against the fundamentals or kicking down the road. At some point it has to stop. But that's the old Keynes saying: markets can be irrational longer than you can be liquid. So I would never take a guess on the timing when these current market environment unravels. I don't know.
All right, so let's move into due diligence and what that looks like. So you mentioned you meet with over 100 managers per year.
Well, we have manager context that includes obviously conference calls, and these days even more conference calls than before. We normally attend CTA conferences, like the one in Miami, for example.
Yeah.
And we also, at least that's the policy, pre-corona, we have to visit the manager on site at least once before we can invest.
I feel like this crisis is going to kind of do away with that. I feel like the fancy New York hedge fund address is going to go by the way, and you're going to have managers all over the world now. You'll be like, I'm going to set up shop in Jackson Hole, or right.
Oh, that's actually funny you said that. I just had a conference call with the manager from Jackson Hole last week, but in our yes,
we know.
All right, good, great. Actually, in our smaller manager space, it's much more all over the place than with the larger names. You know, the two people out of a garage, I don't know, that may be the wrong description, but the two people can afford to have a proper office in New York downtown. They sit somewhere, you know, upstate New York or this. Yeah. They can do everything with their computer from home, from their lovely Rocky Mountains mansion. So
yeah, I think that's just, this is going to push that further along, and you're going to see more of that. So you have the 100 people on your list, and then you meet with some subset of that. And then what is that? We have split the due diligence in 3 parts. The first is the screening. So we always want to know what's going on. So we subscribe to the Barclay Hedge/CTA database, and we scan this database. We have some algorithms that scan the database for new entries and rank them by performance and by performance per strategy and so forth. And if there's any manager coming up that we don't know or never heard of, then I normally book a meeting with them to get to know. So that's the first thing for a manager that wants an allocation from us, is to start reporting to the Barclay Hedge database, or send me an email. You know, this is my program. I have a track record here. What do you think? Yeah. Let's book a call. So that screening goes on, can be quite, because we're looking at smaller managers, we don't have the luxury to do one due diligence per manager. We don't do this anymore. Since 2013, we do this in batches. We basically collect 4 to 6 interesting names, 4 per strategy. So, and then we do 5 managers or 5 programs at the same time. So if we have, let's say, only 3 managers on the short-term trading to watch list, we're not going to start a due diligence round on short-term trading, and those managers might get impatient. You know, we've been in contact for 1 year now, but you know, if I need to have this group together first. Got it. And that has to be not just the number in that sector, but the number that you're interested in and want.
Yes, and interesting means for us that there are, as I said, some kind of edge, some kind of innovation. They should also know what they're talking about. They should be able to explain it to me what they're talking about. It always helps if the manager knows herself what their strengths and weaknesses are. So that's something that I can do in the number crunching and check if that's true. That's what.
Sorry, go ahead. I was going to say, if they have good numbers and can't talk to it at all, they're out, in your opinion?
Yes. Yeah. If they can't explain where it's coming from, then I don't know. That's not for us. That's would require too much digging, which we can't really do, right?
Yeah, and I think a lot of managers feel like, "What? I don't need this narrative. I don't need to explain it. I just want to show my numbers." And you're like, "Well, the people allocating the money want to know the story as well."
Yeah, but that's also for us then, helping to allocate to the strategy and managing that allocation over time.
So let's dive into some more of the due diligence. So You're getting the story from them, you're crunching the numbers. What are some of the red flags that you'll see that knock people out?
Well, our due diligence process is split into 2 parts: the investment due diligence and operational due diligence. And in the investment due diligence, I basically try to summarize the trading strategy in my own words and find, market episodes, market periods when this strategy should work and provide diversification or provide performance, and when it shouldn't. And that's what I'm going to check, basically, on a monthly and daily data basis. So, for example, how does the performance react to VIX spikes or slumps in VIX? How does the performance react to spikes and slumps in time series momentum? A red flag in that case would be if we compare performance numbers like Sharp or Sortino or ALSA indices over different data frequencies, and there's a large gap. So basically the Sharp ratio on monthly data is much higher than the Sharp ratio on daily data. That's a warning sign that there's some underlying volatility that I don't understand. For example.
You walked into that there. So you guys use the Sharp ratio? It's been, right? It's rather...
Well, we use it as a for our data frequency analysis. We don't rank portfolios by their performance, you know.
Yeah.
But
it seemed like a Sortino or a MAR ratio is more relevant to me, right, than the Sharp, because
yes,
especially
obviously. But what I'm talking about is just the difference between for the same performance measure for different data frequencies.
Yeah. I like that. And then if they can't explain why that is, right, they're out. And what else? So you want them to have an edge or a perceived edge? Well,
the only thing you can come in our portfolio is you replace an existing manager or you add it to the existing portfolio, right? So if you are added to the existing portfolio, then you have to do something else than our existing managers already do.
And meaning you can't just bring another slightly different flavor of trend following. It's got to either be totally different or have a very new, like you said, another very different flavor of trend following.
Yeah. Or the second reason why you could be in the portfolio is that you're replacing an existing manager that is maybe too old or too big or has breached some of the predefined stop losses, so it has not performed as expected.
And then do you consider background and pedigree and things of that nature?
Well, it's always interesting to know where people are from, what kind of education they have, and it's always a plus, I think, if they have, learned the business at a larger company. So that's always something we like.
Yeah.
Normally, well, I don't want to. I'm directly from university myself, but normally the guys coming directly from university are very ambitious and have not so much experience with what's actually going on in.
Which we've seen in our. Yeah, they'll get frozen in front of the screen, or they'll forget to code something. We see that a lot. And so, what are some of the tips you could give emerging managers to get? To pass some of this due diligence, or does it, at the end of the day, if the strategy doesn't fit what you're looking for, it doesn't matter how good they are in a due diligence meeting?
Yeah, the most important thing is that it's a fit for us. That's something that we need in our portfolio, in a way. And the second thing is that we ourselves provide data liquidity and transparency to our investors, so they can on a daily basis check positions and what are the managers' performances and everything. And obviously, this is data that I want to have or want to collect for the due diligence process. So if you have your data and everything in order, you don't have to produce it just because I ask for it. That's obviously a plus. So, have your sector exposure, sector performance, submodel exposure, submodel performance, and everything ready on a daily basis. That helps the process time-wise a lot, actually.
And what do you say to... We run into this a lot of people like, I don't want to give up my secrets and whatnot. I kind of always say, like, we don't care that much. Like, I don't have the time to recreate your model.
No, right? Exactly. No, it's we are happy to sign any confidentiality agreements, but at the end of the day, we are managed account investors and managed account investors only. So we're going to see the daily positions and performance anyway. So if you don't want to, don't trust me now for the analysis, then we can invest.
Yeah, and speak to that, of some managers afraid of even having a managed account because people can see the positions.
Of course.
What do you say to that? Of that's silly or whatever? If that's your view, that's your view.
As I said, we don't have the time to we want to be a manager of managers. We want to add value on top of what our managers do, so we don't have the time to trying to refigure what they're doing. And our investors, of course, see only the daily positioning and of the aggregate portfolio, right? They see the manager performance, but there's position, so there's no way they can trace which manager is responsible for this, long stock exposure or something.
Yeah, and even if you had it by manager, would you want to trade on a delayed basis, right? You're going to see the positions at the end of the day. Who knows what happened in the hours since then?
Yes.
Like that seems like a recipe for disaster to me. Although that exists, right? Those ETFs that track the hedge fund filings and get into the same positions the hedge funds are in.
Yeah, I heard that. We are not, we can only invest in strategies that trade exchange-traded futures and options and FX forwards. So we don't no ETFs or swaps or alternative markets or anything.
And what do you have any? Has the pandemic come into your due diligence of like what are your work from home policies, or what is your preparedness for?
Well, that would be part of the operational due diligence, right? And there, the first step is to get like references, which are some managers are also reluctant to provide references to their investors, but that's also something we would require. We need to talk to at least 2 guys or 2 people, what's their experiences with you, and then it goes more down to a quality analysis of the people behind there. Who are those guys?
Yeah.
Another part of the operational diligence is to get a verified track record from a third party. So we compare what the numbers that we analyze are actually true or verifiable.
And is it enough for them to just be subject to audit by the NFA? Or does it actually have to be a audited?
No. Normally we get the third party performance figures from the administrator.
Yeah. And then let's talk briefly about how you guys rebalance and view that piece of the puzzle.
Right.
So is it monthly rebalancing, quarterly, some fancy?
It's typically a reallocation at the end of the month. We have a top-down, bottom-up allocation process. So bottom-up obviously is what do the managers do themselves? How are the positions in the portfolio? So basically, if a manager is constantly underperforming its peers, then obviously we would consider reducing the allocation. If all the managers are into long gold at the same time and we have a high concentrations portfolio, there's also a warning sign where we would consider reducing manager allocations in a way that we can reduce this risky position.
Yeah.
And top down, we have some in-house indicators and other outside more macro market indicators that we use to manage the overall exposure and the sub-strategy weights of our managers. So we have like the time series momentum based indicator. So basically, if there has been high time series momentum in the markets going forward, it's less likely that there are going to be more trends. So we're going to reduce allocations to trend and vice versa.
Those are discretionary decisions, or it's formulaic and it'll automatically do it?
It's a structured process. So without the indicators doing anything, we can't do anything. And if we have several indicators, that if more than one is pointing in one direction, like sending a risky signal, a warning signal, then we have to act.
Yeah.
But the whole process is not automatically. It's not says, okay, this manager A, B, and C get a reduction by X amount. That's something.
So there's a bit of art to the process instead of just pure science, right? So a mix of the art and the science.
We've been living with some of the indicators for 20 years, 25 years. So we think we have a good hand in that. And we are, we communicate, we are transparent going forward. We communicate all tactical reallocation, how we call it, with our investors in advance. So we tell them our indicators, which they can see that by themselves as well as on our dynamic RPM website. So they can see the indicators themselves.
Yeah.
Okay, this is a risky environment for trend following now, so we're going to think, starting next week or something, we reduce allocations.
What is that reading right now? Without going to
I can tell you it was actually sending a warning signal by mid-February already. So we started reducing risk by mid-February, and all through March, obviously, we started putting risk back on in mid-April. And this reallocation has actually added 1.4% to our performance. So that's the reason we're up this year still.
Great.
And now in May, we are at long-term average risk regarding portfolio risk level, but also sub-strategy weights. The trend, what's called the time series momentum indicator, is a very low level. And going forward, we are expecting another wave of trendiness. If that's come tomorrow or during the summer at some point. I don't know, but going forward, it's more likely that trend's going to pick up from here.
And how do you guys view the portfolio risk and the correlations? Do you treat the correlations as you see them, or do you assume they might move to one in a?
Well, we have different risk measures, like the typical VER for different look-back periods, where we consider correlations, obviously, but then also the stress and undiversified risk, where we put everything to 1 or -1 in the case of bonds. So we have a risk basket risk. So basically, you measure correlations for all the instruments you trade, and then you build the correlation basket of those, and how concentrated in one correlation basket you are, and what else we have.
So a simplistic example of that would be just take each manager in the portfolio, assume they hit their worst max drawdown all at the same time.
Yeah.
And am I comfortable with that risk number as kind of a worst case scenario?
Yes.
And so what does that number look like for you guys? What's your risk tolerance on the downside in terms of a drawdown
Oh, I don't have that number right here now. So
yeah.
It's actually, we are in a drawdown, so it's, trend following is cyclical, so or CTAs are cyclical, so it's quite low actually.
Quite low, but you're right. You're not willing to take a 50% drawdown or something.
No.
Yeah. Lower.
All our managers have a predefined stop loss regarding maximum daily loss, maximum monthly loss, maximum drawdown depth, and maximum drawdown length. So that's on a manager basis.
They'll be automatically cut if they exceed that?
Happened in March with one machine learning short-term trading manager. Unfortunately, okay. I really like the strategy.
Yeah. As you mentioned it, what are your thoughts on AI and machine learning and adding those types of managers?
Well, as March has shown, it was the fastest spike of trendiness and the fastest slump of trendiness since we started measuring since mid-95. I heard it was the largest slump in equity markets since October 87. Back then, there was hardly any daily data around. So yeah. I doubt that there are many machine learning AI algorithms out there that could have been trained on this scenario.
Yeah.
So, and then it becomes an out-of-sample problem. And from what I've read is that machine learning did not so well during this.
And what's it look like from an investor standpoint of allocating to these machine learning, where it's, maybe you could understand processes in the past, but it seems we're getting to the point where unless you have a PhD and can really dig into their black box, like it's almost impossible to know exactly what's happening inside some of the AI strategies.
Well, we have come across two types of machine learning programs. One is basically the black box that, and the manager is not really able to explain themselves why the signal is the way it is. But that would have been a no-go for us from anyway, because we want the manager to understand their own strategy and explain it to us, right? And the other part of machine learning is basically where you use the machine learning to weight your signals or your submodels or what have you. You have to, for example, there's a fundamental manager here in Stockholm, which employs 2 ex-RPM guys actually, so we like them. They have decided, okay, we're going to be just global macro, so we're just going to do flow analysis and interest rate differentials and all that stuff. But the weighting of those models, that is up to an AI machine learning procedure. So, and that I totally buy. The machine has much more capacity to quickly adjust. Okay, these kind of models don't work these days, and these will have a better performance expectancy, so forth. And that's something that we consider investing in.
Yeah, and I think we see more of that on our side as well. Machine learning used to build portfolios or add on risk instead of pure black box signal generation. And we were on the one of our pods with Resolve Asset Management. We were joking that for the black box guys, they need to build a black box that generates a narrative around the trades as well. So let the AI generate some narrative of here's why we took these trades, and that's all AI black box based as well. We'll maybe one day see that. Great. Let me. So you got anything else you want to share about the strategy or anything, or we'll wrap up with our favorites?
No, just we just had a manager that we really like to have in the portfolio, but they got really impatient with our how much time our due diligence process takes. So it's a very long process, and we are never in a hurry because we have an up and running existing portfolio. So please be patient with us once we.
And what does that time look like? Months, weeks?
Yeah, months. Well, now maybe it can be faster because we can't do any on-site visits now. But before it was like, I can do all the number crunching I want, and the investment committee can love your strategy, but I have to go to, I don't know, Chicago and check out your office. And I won't just book a flight to the United States to see one manager either. So I have to have a group of managers which I can visit.
What was one of the most remote places you visited to do an on-site?
I would say Logan, Utah.
Okay. Yeah. I know who's there as well.
Yep.
Yeah. Yeah, those guys are good. Great. Let's move on to some of your favorites.
All right.
Favorite ABBA song?
The one with the money? I don't know. I'm not an ABBA fan at all.
Right.
That's the one.
How do Swedish people feel? Well, you're German, but how do the Swedish people feel about ABBA? We love them here in the States. They focus on them.
I mean, if you say something offending, I guess they would get upset. But it's not a daily topic that people talk about or not listen to or anything there. Sweden is one of the few countries that exports more music than imports music. So we have a lot of, current artists that are more on the radio or on people's minds.
Got it. Favorite investing book?
Investing book?
Yeah. Or book having to do with investments or strategies or portfolios.
It's called, I don't want to pronounce, it's called Gut Feeling.
Gut Feeling. Okay.
Yes.
What's the synopsis?
I think the guy's called Gernot Hitz. I don't know. I don't.
Does he recommend just use your gut?
No, but he says some complex problems, it's easier to have like a chain of decisions to make that brings you faster to your goal than building a complicated model.
Yeah. Favorite Swedish athlete, or I'll take German athlete.
All right. That's also, well, in Sweden, it's of course Zlatan Ibrahimovic. That's that's the one everyone adores. In German, I don't actually.
Björn Borg.
Oh yeah, I have he has a famous sports gear and underwear company, or that's his name. So every second Swede you see in the gym has some Björn Borg underwear.
And where do you follow what's it called, the Bundesliga?
I follow the Bundesliga, and the Swedish version is called Allsvenska, but the Allsvenska is still closed down due to Corona. And in Germany, it had started again. So with
no fans, or they're testing.
No fans, but also no public viewing. So I don't really, if you didn't go to the match, then people normally would go to a sports bar or anything and watch matches there. But that's not.
But it's still televised, right?
Yes.
Yeah. All right. Favorite fika spot in Stockholm? I don't even know what that means.
Fika is basically means, it's a verb, and it means having a coffee. So that's and normally you have some kind of pastry to it. I don't do fika so often. I do it at the office here, but fika bar called Vetekatten, so Wheat Cat. That's a famous spot in Stockholm.
Wheat Cat. I like it.
Yes.
And then how long did it take for you to learn the language and the customs? So you've been there since 2005, you said?
I moved here to 2005. I started taking Swedish lessons in 2003. It's a Germanic language, just as German, so it's pretty close. I will never be able to speak it so that people, won't recognize. I'm not a born Swede. But to be able to communicate in a restaurant or on a train or something like that, or in a meeting, takes maybe 2 years.
Yeah. And your English is excellent. Did you learn English in grade school and primary school and in German?
You have to start at the 5th grade.
I think that's it. How about podcasts? You listen to a lot of podcasts? You got a favorite one?
No, I don't. So I have started with a history podcast from the BBC, History Now, Our Time Now, I think it's called. That's
I do
my spare time.
Revisionist history one's good too.
All right.
And then wrap it up. Favorite Star Wars character?
Oh, I have to disappoint you. I'm not a Star Wars guy either.
Have you seen any?
I have seen the first 3 when I was a teenager.
Okay.
So I like them a lot, but as an adult, I figured it's more like it's basically a Western movie with science fiction out costumes.
They call it a space Western.
Yeah, exactly. So, but the guy I like most, I guess it's Han Solo.
I like it. He's good. In our Star Wars investing infographic, he equals managed futures.
All right. So there you go.
Deals in commodities, so background, shows up in a crisis. Han Solo. All right, Alex. Thanks so much for your time.
Thank you very much, Jeff.
Where can people find the website and how to get a hold of you and whatnot? Hopefully you don't get 10,000 new managers calling you tomorrow.
Oh, it's rpm.se for Sweden.
Okay, great. And we'll look for you. Once lockdown's over, we'll hope to see you back in the States or me over there.
I actually booked a vacation trip for September in Europe, but let's see. I'm still hoping that will be possible.
I hope so. No second wave. Yeah. All right, Alex. All the best. Okay. Thank you for your time.
Thank you. All the best. Thank you. Bye-bye.
Bye-bye.
Listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you.